I have put together a very simple income statement and statement of owner's equity from this trial balance that we were looking at. So first of all, on the income statement, we have revenue of $7,000, and I just added up all of the expenses to get $3,200 in expenses, and so our net income is $3,800. Then that net income goes into the statement of owner's equity. So we have beginning capital of $26,500, and I got that from the trial balance. In this case, I am assuming the owners did not make any additional investments into the company during the year, so the $26,500 was just the beginning capital. So from the beginning capital, we add the net income that we got, and then we subtract what the owners took out or the drawings, and that got me an ending capital of $29,300. All right, at this point, we need to look at the process of closing out the accounts so that we can get ready for next year. Now, why do we need to close accounts? And that's because, well, as an example, let's look at the revenue account. Right now, the revenue account has, if I look at the T account here, it has a $7,000 credit balance. Well, if I don't do anything with this, if I don't reset it for next year, this is just going to keep building up and up and up. And if I have my business open for 10 years and I've never reset the accounts, I'm just going to have a really big number in here. That means this is what I've earned over the past 10 years. But what we actually want to measure is how much have we earned this year. So every year at the end of the year, we have to reset the accounts so that we can measure again for the coming year. So what I actually want this to show after I'm done creating the financial statements, I want it to show 0. So I want it to be 0 in this account. So how do I do that? I can use the adjusting framework to do this. Step 1, what is in the account? Step 2, what do I want it to be? I want it to be 0 in this case. And step 3, how do I change it from a $7,000 credit to 0? I have to debit it $7,000. So I need to do this for all of these temporary accounts that measure things over a period of time, because I want to reset all of those so I can measure it over the next year. I have to do this with the revenue account, I have to do it with all of the expenses, and I have to do it with the drawings account as well. So all of these things over here, I have to reset them to 0. So we looked at how we do that with the revenue account. Let's just take one of the expenses and see how we would do that. So the salaries expense account right now is at $500. And that's a debit. So again, the adjusting framework, what is it? It's a $500 debit. What do I want it to be? I want it to be 0 to reset it for next year. And step 3, well, how do I change that? I need to credit the salaries expense account $500 in a journal entry. So let's step more into how do we put together these journal entries. Well, first of all, let's look at how we reset. We're going to do this in 4 steps. Realistically, I mean, you could do this in 1 step, 2 steps, 3 steps, 4 steps. I have seen textbooks do 3 steps, some textbooks do 4, and really you could do it all in one if you wanted, but our textbook does the 4-step process. So we are going to use that one. All right, the first step is to reset the revenue account. We already said we need to debit the revenue account. So we are going to debit service revenue, $7,000. what do we credit? We are going to make this, I want to call it a temporary account, but it's not a temporary account in this, like up here in that instance. This is just, this account exists for a very brief period of time. It is called income summary. So we are going to put all of our revenue into income summary. If we have more than one revenue account, we list out all of the revenue accounts here on the debit side. So if I had like product revenue, I'd also put that underneath service revenue and put the total into income summary. All right, so once I have all of my revenue in income summary, I'm going to move on to the expenses. Right now I have salaries, rent, utilities, and miscellaneous. They are all debit balances, so I need to credit all of them to reset them to zero. So let's just go rent expense. I'm just going to go down the income statement here. Rent expense, credit that $1,100. Utilities, $1,000. These are all expenses. I'm not going to write out expense every time. Salaries expense, $500. Miscellaneous expense, $600. And the total of that goes into income summary. But this time I am debiting income summary, and this one is going to be $3,200. All right, so if we took a look at what is in income summary right now, notice whenever I make a journal entry, doesn't matter if it's a normal journal entry, adjusting journal entry, closing journal entry, I always have to post it to the ledger. And income summary has its own ledger. So the first time I credited income summary $7,000, and then I debited it $3,200. So what is in the income summary account? Well, it's a $3,800 credit. Where have we seen this number 3,800 before? Well, guess what? It's right here. It is our net income from the income statement. We saw it right there. All right, so by the time we are done resetting all of our revenues and expenses, what should be in the income summary account is what was on our on the income statement. All right, I'm going to erase a few things here so that we can have a little bit more room here to work. All right, so we have now successfully reset our revenue and expense accounts, and net income right now is in the income summary. Well, the third step, so I'm going to do the third step all the way up here. So sorry about the having to do this here, but we're going to put the third step up here. Third step is resetting that income summary account. I said this is going to only exist for a brief period of time, and we're getting rid of it already. So right now we have income summary at $3,800. We want it to be zero. So in this case, we say, all right, we have a $3,800 credit. That's what's in it. I want it to be zero. How do I get rid of it? I have to debit income summary $3,800. Where do I put that? I put it in the capital account. When the business earns money, who actually gets to keep it? Guess what? The owner gets to keep whatever the business earns. That's what this step is doing. It's saying this $3,800 in net income that the business earned, who does that belong to? It belongs to the owner. So we have now added the net income to the owner's capital account. Guess what? That's right here. That's our statement of owner's equity. So we added the $3,800 to the owner's capital account. The fourth step is resetting the drawings account. So we're at this step right now. We have $1,000 in the drawings account. If we looked at that account, we have a $1,000 debit. So how do we get rid of it? We have to credit the drawings account $1,000. Well, what do we debit in this case? Well, who took out the drawings? The owner did, and it came out of their capital account. All right, so this last entry successfully resets the drawings account for the next year. But more than that, let's look at the capital account. We started with $26,500 as a credit. And then we added another credit of $3,800 and then took out a drawing of $1,000. So we debited the capital account $1,000 right here. All right, so what now is the balance in the capital account? Well, if I add all of this up, I should end up with a credit balance of $29,300. Have we seen that number before? We certainly have. It's right here. It's the ending capital account on the statement of owner's equity. So the closing process, the goals are twofold. One is to reset all of those temporary accounts so that we can start tracking things for next year. The second goal is to update the capital account. We put the net income into the capital account and we take out the drawings out of the capital account so that the ending balance in the capital account matches what's on the statement of owner's equity and the balance sheet. All right, one last thing here is once we have done all of these journal entries and posted them to their respective ledgers, we need to put together a trial balance. Now, what's going to be on that trial balance? Well, we have not changed cash. We did not change accounts receivable or supplies or long-term notes receivable or equipment. We did not change any of those. The only things that we changed, well, we got rid of drawings, that's 0. Service revenue is now at 0. All of these expenses are at 0. Capital has been updated to $29,300. So what distinguishes a post-closing trial balance from any other trial balances we have put together is there are no drawings, there are no revenues, and there are no expenses on it because those are all deemed to be 0. That is the last step in the accounting cycle that we are doing. If you remember graphics of the accounting cycle, let's just go take a look at those here. We started off with transactions, and then we make a journal entry, post it to the ledger. And when we do that over and over, when we're ready to make the financial statements, we break out of that cycle. We make an unadjusted trial balance. We go through that line by line. We say if something's wrong, we adjust it. Whenever we make an adjusting journal entry, we post it to the ledger. We do that several times. When we are done, we make an adjusted trial balance. From there, we make the financial statements. After we make the financial statements, we need to get things ready for the next period. And that's where the closing process comes in. So I said we would finish this cycle. We make the closing entries that we just looked at. Closing entries are just like any other journal entry. We looked at the 4 that we need to make. Whenever we make a journal entry, we have to post it to the ledger. And Again, there's going to be a cycle here because we have to do that 4 times. And when we're done with all of those entries, we make a trial balance. And that post-closing trial balance, all of the revenues are 0, the expenses are 0, the drawings are 0. We are ready to begin the next cycle. So that's the whole closing process. We make those 4 journal entries, and then we make the post-closing trial balance. We're ready for the next year. Before we finish up this video, I do want to point out the patterns in the accounting cycle. Whenever we make a journal entry, we post it to the ledger. And we see that several times. We saw that in our initial regular journal entries, so to speak. We had regular journal entries, we post those to ledger. We have adjusting journal entries, we post that to the ledger. We have closing entries, we post that to the ledger. Also, whenever we are done with one of these like subroutines in the accounting cycle, we make a trial balance. So we make a whole bunch of journal entries, and then we make a trial balance. We make a bunch of journal entries down here. We make a trial balance. And when we make closing entries, we make a bunch of those, and then we make a trial balance. So we see some patterns here whenever we look at the accounting cycle. The last thing I want to say about the accounting cycle is the whole reason that we go through all of this work is to make the financial statements. So none of this really matters unless we are making the financial statements. That's the whole point of accounting, is we make financial statements, and the purpose of those is to communicate information out to our stakeholders, our shareholders, and whatever. So just keep that all in mind as we finish up our accounting cycle with our closing entries. We have now completed all the basics of accounting, and so you know the entire cycle and all of the different types of journal entries that happen in the entire cycle.